Hello and welcome to this beginner's guide to exchange traded funds, or ETFs. This is the first in a three-part series where we're going to look at ETFs. In this video, we will explore the top ETFs by different categories and an example of how to build up an ETF portfolio. In the second and third parts, we will explore the best ETFs by sector and dividend ETFs. A word of caution. Please don't take this video as investment advice. I'm a random bloke on the internet providing a summary of my research, which is based on a couple of decades of experience, but please do your own evaluation before investing your hard-earned dollars. Before we get started, please consider subscribing or liking this video, as it really helps get the channel out to more people. There's no sugarcoating it. The recent pandemic has been brutal to most. Interestingly, it has introduced the stock market as one of our favorite new pastimes. If you're like me, I'm sure you've seen some of your mates make an absolute killing buying and selling stocks, options, and other fancy instruments that frankly can get pretty overwhelming. In fact, analyzing stocks are hard, be it fundamental analysis looking at financial statements, or technical analysis looking at support and resistance lines and various trend indicators. And in all that confusion, you end up picking the most hyped up stock at the highest price, which more often than not ends up badly right after you finally buy into it. One winning strategy is to pick up exchange traded funds, or ETFs. So what is the difference between a stock and an ETF? Why is one better than the other? So owning a single stock is like owning a cow. It may be the best cow ever, but if it dies or a company goes bust, you've lost everything. Literally everything. The entire cow. An ETF, on the other hand, is like owning a whole herd of cattle. Some cows are going to be better than others, but if one dies, even if it was your favorite cow, sure, it's bad, but it's not the end of the world. You're not going to lose all of your investment, just a part of it. So it's an excellent way to diversify risk in the stock market. Research suggests that over a long time frame, a general market ETF will, in almost all instances, beat an individual or even a hedge fund picking individual stocks. So what should you look for in an ETF? Well, I have three criteria to make sure my ETF investments are safe. Number one, low fees. It's the pennies that make up the dollars. And the lower the fee, the better the returns you're going to make. Number two, choose an investment that is very liquid. That is, it's traded frequently in the market. And number three, as with the second point, the size of the fund. A large fund has a seal of approval from many investors in the market, so you're more likely to be able to buy and sell it at a decent price. But which ETF should you buy? There are literally thousands to choose from. Now let's say you are Frugal Freddy. You've always cared about your finances and your financial future, and on the first working day of each year since 2016, you've invested $1,000 into an ETF. So by the middle of 2021, you've invested $6,000. How much money would it be worth today? I'll talk about three different categories of ETFs before I get on to my favorite five. So those categories are US stocks, global stocks, and commodities and bonds. First up, US stocks. Now your $6,000 investment would be worth between $8,500 and $12,000 depending on where you invested it. Let's look at these different indices. First up, Vanguard's Total Market, VTI. This fund tracks the total US market, which includes large, mid, small, and micro cap stocks that are trading in the New York and Nasdaq Stock Exchange. This is a $1.2 trillion fund with a yield of 1.3% and an expense ratio at just 0.03%, about as low as it gets. Next up is Vanguard's VOO. This is the Standard & Poor's 500 index tracker, the 500 largest publicly traded companies. Its assets stand at $750 billion, yields at 1.4%, and an expense ratio of just 0.03%. We're talking about companies like Apple, Microsoft, Amazon, Google, Tesla, Berkshire Hathaway, JP Morgan, and so on. Next up is the Nasdaq tracker, QQQ by Invesco. The fund is $160 billion in size. Yields are non-existent at 0.5%, and the expense ratio is a little bit higher at 0.2%. The fund tracks companies like Tesla, Apple, Google, Microsoft, Amazon, Facebook, PayPal, and so on. Now there's also a QQQM, which is the exact same tracker, but with a slightly lower expense ratio of 0.15%. However, the fund is much smaller in size at about $1 billion, which means it's not as liquid as the QQQ. If you wanted to track the Dow Jones, I'd go with State Street's DIA, with assets of $30 billion, yields of 1.7%, and an expense ratio of 0.16%. So this includes companies like Goldman Sachs, Microsoft, Boeing, McDonald's, Salesforce, and so on. Finally, we have the iShares Russell 2000 tracker, IWM, with assets just under $70 billion, yields of just under 1%, and an expense ratio of 0.19%. The fund includes the more mid to small cap companies, so companies like GameStop, AMC, Plug Power, Caesars Entertainment, Novavax, and so on. Staying on the US stocks theme, you can also get funds that are a bit more focused. The first one is Vanguard's VUG, that's focused on S&P 500 growth companies. It has assets of $150 billion. Yields are a bit low at 0.6%, but the expense ratio is just 0.04%. Again, the usual growth suspects: Apple, Google, Amazon, Facebook, Tesla, Visa, Nvidia, and so on. Then you have State Street's S&P 500 Value Companies Tracker, that's SPYV, with assets of $13 billion, yields just over 2%, and a low expense ratio of 0.04%. These include value companies in the S&P 500, so Berkshire Hathaway, JP Morgan, Disney, Bank of America, Johnson & Johnson, Verizon, Intel, and so on. Third is Schwab's SCHD, my favorite dividend ETF, tracking the Dow Jones US Dividend Index, and companies like Home Depot, IBM, Pfizer, Coca-Cola, Texas Instruments, and so on. This particular fund is about $25 billion in size, and with yields of 2.8% and an expense ratio of 0.06%. The returns on all three of them would be quite similar. The $6,000 would be worth around $9,100 today. If you're willing to take on a little more risk and willing to accept an investment beyond just the US stocks, I'd go with ARK Invest's ARK-K fund, an actively managed fund aimed at disruptive companies such as Tesla. This is another $25 billion fund with a slightly higher expense ratio of 0.75% and yields of 1.7%. If your investments is aimed specifically at the ESG sector, so environmental, social and governance, I'd use Vanguard's ESGV, a $4 billion fund with an expense ratio of 0.12% and yields of 1%. This particular fund tracks the FTSE US All Cap Choice Index, so that includes large companies like Apple, Microsoft, Amazon, Google, Tesla, JP Morgan, Visa, Facebook, and so on. Our next group of ETFs is global stocks. So your $6,000 investment would have netted you much lower returns than the US market, so around $5,500 to $7,500. If you wanted medium to large companies in the entire world, excluding the US, your pick should be Schwab's SCHF. It has around $25 billion in assets, providing yields of nearly 2%, and with an expense ratio of just 0.06%. Top holdings are Samsung, Nestle, Roche, Louis Vuitton, Novartis, Toyota, SAP, AIA, Unilever, and so on. If your focus was on emerging markets, a good one is iShares IEMG, which covers China, Taiwan, India, South Africa, Brazil, Mexico, Korea, Russia, Middle East, amongst other countries. The fund has $80 billion in assets and with a yield of 1.8% at an expense ratio of 0.11%. These are companies like Taiwan Semiconductor, Tencent, Alibaba, Samsung, Meituan, Reliance Industries, JD.com, China Construction Bank, etc. If your focus is on Europe, I'd suggest the Vanguard's VGK, another $25 billion fund with a 1.9% yield and a 0.08% expense ratio. This one tracks major European markets, so companies like Nestle, ASML, Roche, Louis Vuitton, Novartis, SAP, HSBC, etc. For a fund aimed at developed markets in Asia Pacific, I'd use VPL, a $9 billion Vanguard fund with a yield of 1.9% and an expense ratio of 0.08%. There's around 2,500 companies in this index from South Korea, so like Samsung, Japan, so Toyota, SoftBank, Sony, amongst others, Hong Kong, like AIA, Singapore, like the Overseas Chinese Banking Corporation, Australia, like the Commonwealth Bank of Australia, BHP, CSL, and New Zealand, like Westpac, ANZ, Telstra, and so on. A very well diversified fund in that region. For a LATAM strategy, I'd go with ILF by iShares, a smaller $2 billion fund with yields of 1.8% and a higher expense ratio of 0.48%. So this includes large Latin American companies like Vail, Bank Bradesco, America Móvil, Walmart, Mexico, etc. Now you would have noted you would have lost money in this particular investment and your current value of investment would have been lower than what you actually put in. Finally, if your focus is on Africa, you'd have limited choices. But I'd consider VanEck Vector's AFK, a very small $56 million fund with a high expense ratio of 0.79%, but also high yields of 3.7%. The fund follows the Dow Jones Africa Titans 50 index, so companies that are either listed in Africa or do at least 50% of their business there, like Naspers, Safaricom, Maroc Telecom, Anglo American, MTN Nigeria, Zenith Bank, and so on. Our final categories is on commodities and bonds, a lower risk, lower reward segment. First up is State Street's GLD, a $65 billion gold ETF at an expense ratio of 0.4%. The next one is iShares SLV, a $16 billion silver price tracker. If you're looking to track crude oil, I'll go with USO, a $3 billion fund with a 0.83% expense ratio. Now, this isn't a standard ETF. Its prices are based on futures contracts, so better suited to short-term traders, as you'll note from the rather low long-term returns here. For more diversified commodities, there's Invesco's PDBC, a $5 billion fund with an expense ratio of 0.59% that invests in financial instruments that are linked to the world's most heavily traded commodities. So commodities that have tangible properties like oil, agricultural products, raw metals. Finally, a bond-focused ETF. My favorite is Vanguard's BND, a $300 billion fund with a 0.04% expense ratio that tracks the performance of the Bloomberg US Aggregate Float Adjusted Index. So a measure of the wide range of investment-grade fixed income securities like government, corporate, mortgage-backed and asset-backed securities, all with maturities of more than 1 year. So what do you do with all of this information? My suggestion is to work out a portfolio strategies. In building up a portfolio, I would think about the different types of stocks I would want to track. So in my case, I would want emerging markets, Dow Jones tracker, because I think the market's going to pick up as we recover from the pandemic. Something with dividends so I get a regular income. An S&P 500 tracker, which is guaranteed to give decent returns over a long period of time. And something that's focused on technology and growth companies. So I would have picked the IEMG, the DIA, the SCPD, VOO, and QQQ. Over time, I might decide to move into bonds and gradually introduce a BND investment in here. So I hope you found this video useful in getting you started in building up a strong, well-diversified portfolio. If it was, please do smash the like button or leave a comment. Do subscribe and you'll be notified when I publish parts 2 and 3. Look forward to seeing you then.